Okay, good afternoon, everyone, and welcome to our second event of 3 for this week. We've got another 4 ASX microcap companies to present their most recent results with us this afternoon. For anybody who is joining us for the first time, my name is Mark Tobin. I'm the founder of Coffee Microcaps. I've got a couple of quick intro slides, and then we're going to get straight into it with our first presenters. I'd like to make special mention of ShareSite, who are our virtual event sponsors here at Coffee Microcaps. If you are deep in trying to get your tax return out to the ATO and trying to track dividends and capital gains and all that, please check out ShareSite's offering. I use it myself. It's a great piece of software if you're trying to keep all of that in order. Quick compliance and disclaimer slide. For anybody joining us for the first time, the companies we normally have presenting on here are no different this afternoon. Capped under 300 million in revenue, approaching cash flow break even, and indeed are already profitable. Generally, we don't have companies on here from the resources or biotech sector, but I like to term industrial microcaps, which covers everything from technology, healthcare, professional services, retail, consumer, kind of anything that generally falls out of resources and biotech. Structure today's webinar, we've got 4 companies presenting over the next 2 hours, 20 minutes of a preso and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel most likely early next week. You can follow us pretty much on all the socials, Twitter, YouTube, as I said, for this recording. And indeed, yesterday's event is already up there, and we have well over 100 company presentations loaded onto the channel now. LinkedIn, and I do write a free monthly newsletter, which you can get on the Substack platform, which will be coming out early next week also. First up, we're going to have Wrkr Ltd. I'm delighted to be welcoming them here for the first time to Coffee Microcaps. After that, we will have cash converters with us. And then we're going to have QANTM IP, who are coming back to give us an update. And we're going to head out west then for our last presenter, Dan Madden, who has presented here a couple of times before, will be coming to give us an update on the Joyce Corp results, which actually just came out this morning. But that's enough from me. So I'm going to stop sharing my screen and ask Trent and Karen to start sharing their presentation, and I'll let you guys know once it's up and live here.
Thank you.
Yeah, it's coming
Thank
through.
You very...
Trent. Yeah.
There we go.
Yeah, that looks perfect, Trent. You can take it away, mate, whenever you're ready.
Wonderful. Thanks very much, Mark, and thank you, Coffee Microcaps, for having us on this morning or this afternoon. Myself, Trent Lund, and Karen Gilmour, our CFO, joining. I'll just run you through what I want to do. This is the first time we've been on Coffee Microcaps, and I'm conscious many of you have probably followed some of the companies presenting a couple of times. So we'll start off with a bit of an introduction about who we are and where we play in the market. And then we'll finish at the end with the financials, which were also posted on our website, Investor Hub, from yesterday's postings. So without further ado, I'll jump in. We all have our obvious disclaimers. Let's just talk about who we are. First of all, we are what's commonly known as a reg tech business. So we are in regulation technology. We specialize in all of those complex transactions that are required to be a compliant workforce, particularly around the compliance matters between an employer and an employee about hiring them, bringing them into your payroll, selecting their super, and then ensuring that they stay continuously compliant, including the processing of their pay. That's the core of our business. It's a high volume game, but an enormous amount of complexity and high barriers to entry to play. So our role is really to revolutionize that space, move it away from paper, move it into digital, focus on high security, And we are obviously a modern company born in the cloud. In terms of just diving in a little bit deeper, we really focus on all of those compliance moments where today many companies service that either on paper, email, in every format you can imagine that causes data breaches and security risks, but also in a method that doesn't build on their brand and typically creates large errors which kick off downstream. Doesn't sound like much to get the pay incorrect for an employee, but it's a fairly hard start to your brand for an employee to experience missing their mortgage on their first month when their pay doesn't make it into their account, and how long it takes to resolve. So that's the space we play. We're very much geared around being mobile centric and in the brand of the various employers. And I suppose the way to think about our positioning is that space again of pay through to that continuous view of compliance. So if you're an employee coming into the healthcare sector, it's important to identify who you are, to comply as an employer, to ensure that you are meeting your stapling and your super choice regulations, to allow that employee to select their super, enroll into either their original or make an active choice in their super, update their tax file number, their tax declaration details, and then take that information and ensure that every time they're paid, that correct amount is paid through to their super and to their pay, and then single touch payroll reporting to government. That is the bread and butter of Wrkr, but where we really extend is into this ongoing full-time compliance view. So I take that same medical worker as an example. It's one thing to do all of those connections, but then we go further into things like visa checks. Do you have an accurate visa to work in Australia? What are the regulations around that visa? Have you been hired? And do you understand the correct policies? Have you been classified correctly as an employer? And have you had your Wrkr medical license checked and assessed, which has to be checked every single day that you work for any medical organisation, just as one example, whether you work behind the counter of a chemist. So that's the space we play in. They are small transactions, but incredibly complex, and require us as an organisation to have little over 20 complex licenses, from being a digital service provider, tier 1 status with the ATO, through to ID check with Government Australia, through to a range of various other federal and state departments. So that's sort of the background on the core of our business. So a volume and scale game. But it is an enormous market in terms of there's about 13.1 million Australian employees who need to be paid on a regular basis. From a super, if I just take superannuation processing as an example, which is a cornerstone element of what we do, there's about 160 million transactions a year right now, with in 2026 with payday super, so super having to align with your pay, that's about 500 million transactions per year. So our platform, again, used extensively by some of the Superfunds in the market to help process those contributions on behalf of their employees. And that's really the core. So we see an enormous market for ourselves and continue to grow into that market, but increasingly other countries are adopting the Australian standards, and we're already seeing interest of our solutions with our existing partners and clients moving into other markets such as Hong Kong and the UK. And that complexity of compliance, the best way to describe it, it's valuable for us. We typically, to process any employee's super within a year, is anywhere between $2 and $6 for an employee, $5 to $15 to process pay and manage all of the compliance messaging underneath that. To onboard an employee costs between $10 and $22. And then to comply, keep an employee compliant and ensure, for example, if you have a visa and you're a student, that visa must be reassessed and attested every month. Your Wrkr medical every day. So that ranges between $50 to $100. But the licenses required to deliver those services are iterative. And so we are fortunate enough to hold most of those licenses required. In fact, all of the licenses required for those services. but probably one of the widest reaching. So the cost and effort, that is years and years of work and proof points to reach into that. So that's just a bit of value, a bit of explanation on what is the business of Wrkr and where are we. You don't often see our brand, although only newly branded about 18 months ago. We are behind the scenes in the market. We already touched today about 2.9 million working Australians, 70,000 employers, over 500 financial advisors or accountants supporting self-managed supers. It's actually about 28,000 SMSFs in total, about 22 that use our software to ensure that they pay and meet the messaging requirements. And then major super funds such as Australian Retirement Trust is a very good example, one of the largest, I think, in Australia. And so that really, background on our business, and then we can kind of stretch it apart a little bit and share some more. But I'll let Karen jump into the detail of the financial results, and then what I want to do is just share a little bit about our journey to date, and how we got here, and really where we're headed from here as a business. Karen, if you want to take on.
Lovely, and good afternoon to everyone who's joined. So we've kept kind of this slide fairly, not too detailed. I basically just wanted to highlight we've got our results that have come out this year, and we're really happy with the financial performance and the direction that the business is taking. Those investments that Trent has spoken about in terms of our ecosystem and getting that licensing and being, compliant with the regulatory bodies has really given us this platform that we've been able to invest in to grow in terms of our products and our security architecture, and to see that journey forward and to see this revenue growth coming in off the back of that is fantastic. So you can see there 3 consecutive years of good revenue growth. Our revenue is really broken up into 3 categories, which is Wrkr Pay, which is those transactional style revenues, which is the processing of super contributions through our superannuation clearinghouse, the processing of STP data, and making pay for other disbursements such as wages and payroll, etc. Then we have our Wrkr platform, and that's live in the market. You can see that technology in the Beam platform for Australian Retirement Trust. We have other entities that we provide kind of digital solutions for our services that are being widely used in the market and highly regarded. Through that, we get licensing revenues and support and maintenance. The third area is our Wrkr Ready. So that's the onboarding. So that seamless process of capturing employees' data into your payroll systems, making sure that there's verifications on that data so you don't get issues down the line, and capturing that super choice moment and stapling moment through a digital and automated way. So that's the Wrkr Ready revenues. For this year, in financial year 23, we had a 43% growth in our revenues. That came from data messaging through our SMSF ESA, Electronic Services Address service, which has had an enormous take-up in the market with over 21,000 trustees taking advantage of that system. So we only started that when rollovers 3.0, which was one of the increased regulatory requirements from the government, came in to capture more data points of SMSFs. So that's been a fantastic result for us. In addition to that, we saw the return of higher interest rates and therefore float interest income on our cash balances on those superannuation contributions, which has been a great result. And we've used that money to invest further in our product development and really set ourselves up and positioned ourselves to take advantage of the opportunities that are ahead of us with, through funds, payrolls, enterprises. So yeah, we're looking to a great year ahead. I say that at the same time, we're having to manage our working capital. We got a great cash injection in FY23 from a couple of capital raises, one through the issuance of convertible notes and another through share purchase plan that raised us 4.2 million. So we're starting FY24 with a great cash balance. we're looking to really manage where the investment of that money goes to set ourselves up for high return sooner than later in terms of our growth trajectory, and really sticking to that strategy of managing our working capital, investing in the right places, the right people, the right products. So in doing that, this year we saw an improvement in our cash burn rate of 21%, which was fantastic to see, and our cost to income ratio improved by 20%. We also saw additional diversity in our revenue, and that has brought in an increase to those annual recurring revenues, which is going to be another focus for us in FY24, to keep that annual recurring revenue figure growing, and setting ourselves up for good growth and market valuation. So I think that's probably the key things that I wanted to highlight. We have a market presentation that we did yesterday with a bit more detail around our financials that's on our website in our Investor Hub, if you'd like to check that out. But for now, I'll probably pass back to Trent to kind of wrap up on his comments about the outlook ahead.
Thanks, Karen. So look, obviously, I think the numbers speak for itself. Although, as typical, we're a microcap, small organisation. What we have managed to do post merge is navigate what I would call the size challenges of we would all like to spend to grow, but we do believe you need to be respectful of the available working capital. We, as an organisation, seek to avoid dilutionary events for our shareholders, hence why our recent raisings were a convertible note and a share purchase plan made available to existing shareholders, because we do believe the business is poised for very, very strong growth ahead. But our view is we have very strong controls in place which allow us to kind of take that growth on organically. We're expecting as a business to be EBITDA positive in 2025. Decision to pause to 2025 primarily around we have large contracts scheduled ahead of us that will require us to continue our current investment cycle, no more than we invest and spend today, but focus on that investment to onboard large clients that are multi-year contracts. So this is in the superannuation contribution processing, and in particular, those contracts moving forward into our business are all done on our own financial services license with our brand, with direct terms and conditions being signed by the customers, employers of the Superfunds. That's a really critical point for those who know our industry. What it really means is we get to leverage the go-to-market of some of Australia's largest super funds as they go out to their employer bases. Those employer bases average around 100,000 employers, up to, in the hospitality space, up to 300,000 employers, which introduces our software by the very nature of us delivering services and income to them. Certainly something I went into some detail in my last presentation. I'm happy to take questions on. So as a business, very excited from our perspective on the trajectory that we've taken the company. That turning point, and it's sort of a little evident in the slides that you see here. The original business in Paytech had a direct customer base that was relatively small, and so vulnerable in size and was in decline. The merge with our company Bond or ComplyPath really then reset the business. We spent 12 months post-merge. I was the original company of ComplyPath, was a spin-out from PwC, and was the original company and builder of Beam, which is the largest platform for integration to payrolls in the super industry. We took that IP and core technology and rebuilt the InPayTech and business. And once we were happy with where we'd taken that business to, that's where we made the decision to launch into the new branding. And as you'll see, it's been strong growth and organic growth since that time. There's been no additional acquisitions to drive that growth. That is purely a case of just organically bringing on new customers. And that's the phase that we sit in right now. So without going too much further into it, obviously, feel free. There is we've recently established our own investor hub site. We have a lot of information, and we're very proactive in answering any direct questions for investors after they've had a chance to digest the summary of our financials. But without further ado, I thought we could open up, Mark, to Q&A, and leave it to you to moderate that, and we'll be as transparent as possible.
Yeah, we've got one here. I think maybe more for Karen, but Trent, if you want to take it, you can either just on, a kick up in revenue. It talks to Karen's slide, but kind of the EBITDA loss increase. So there's just a question around operating leverage and where the kind of scale in revenue starts to kick in for what is ostensibly business that should have good operating leverage, I guess. But I think, Trent, you touched on there in your closing remarks on the investments that you're kind of making on these like big projects. Is that really where the kind of difference is being lost, if I can put it in inverted commas?
Yeah. I'll let Karen add to this, but there's a couple of key points. One, the challenge of all microcaps and being listed, there's a minimum entry to play. There's a cost of board listing fees and all of the other things. It doesn't matter whether you're 1 million or 10 million. Those costs are fairly consistent. We're a highly regulated business, so we function with an AFSL for non-cash payments. We're a GNGB gateway, so under Australia's critical infrastructure for the federal government for the processing of super. Our tax roll with the ATO, so we have a direct connection two-way with the ATO for lodging tax information and receiving information back. So, and they're just a small percentage. So that, although we have enormous barriers to entry for someone else wanting to come into this space, it drives a minimum cost to play. So really, the forward growth for our business is all future revenues are additive on top of the platform's very well baked. It's it's tested under very, very large scale. It's quite an advanced technology suite, but all of the costs of running and operating those licenses are a minimum standard. So as we bring on volume from here, it's very, very high gross margin from that perspective, and all of our forward contracts are very much in true SaaS ARR format, which is much healthier set of revenues and no lumpiness in them from the services. We always use services as a precursor to bringing on those large volume transaction contracts. So that's a stage that we're just about to move into over the next 12 months as we seek to bring on another couple of larger clients. Yeah, if you want to add to that, Karen.
Yeah, I guess just adding to that is, although our revenue increased by 2 million, our EBITDA did increase. It wasn't in the same proportion. So we are starting to see those efficiencies come through. So yes, we've had a lot of investment into the development of the product, and to position ourselves to take advantage of the opportunities now, and really rolling out and scaling up on our SaaS revenue generation. I feel like we're moving from this development consulting phase into 24 into more of an implementation and ongoing SaaS revenue generating part of the business.
Can we just maybe stay on that for a second, that transition, Karen? In terms of, if I'm an employer with, I've got like 50 odd employees, am I paying a license fee for the software to manage it, and then there's a per transaction thing happening, and is that license fee monthly or annual? Just maybe give us a sense. And then if we look at the overall picture of the revenue just gone, how much of that is SaaS and how much is transactional, and just to give us a gauge of, it's probably in one of your more detailed presentations, but give us a gauge of where the kind of revenue split is at the minute, and what it might look like if we get out to, 3 years hence?
Yeah, so I'd say at the moment, without the figures in front of me, we're looking at around probably 50-50 split in terms of that kind of development consulting work, as opposed to our more platform as a service and SaaS as a service, which is that really annual recurring revenue at the moment. And so with some of, like, we've had some work with Link in terms of, doing a development, a detailed plan about how they could use and transform their business in their technology space and services they provide. That's kind of that consulting revenues that we're talking about here. And, a stapling solution that we built into the Beam platform is another kind of development once off. So then we move into the more transactional phase, which is that SaaS revenues charged per month for ongoing transactional levels, as well as there's some license fees as well that are generally annual. But it really depends on the product and the segment of the market. So whether you're an employer, whether you're a fund, and whether you're an administrator, as to how those kind of license arrangements or transactional arrangements are set up. In the example that you provided, if you're an employer with 50 employees and you're using our super contribution, STP and pay solutions, then that would be kind of monthly based on transactions. Hope that kind of answers that question for you.
So it's all geared on the variable is the transactions, and so it's always done as a license and an annual license, and then the transactions on top. And the reason they vary is if you're an employer who pays weekly, your transaction count is much higher. If you're an employer who pays monthly, you have lower transaction costs overall, but you're probably paying your employees a fair bit more.
Yeah. And then just a question, I also had it down here as well, just around interest income on client cash. Does this follow kind of, the like Macmillan Shakespeare kind of model where, people pay you 3 days ahead of when it actually needs to get paid into the bank accounts? And I guess with interest rates after kicking up over the last 12 or 18 months, that actually interest income starts to become meaningful, especially at a revenue base that you're at.
Yeah, no, you're right. We sit at about between 1.4 and 1.5 million of interest income with the interest rates where they sit right now in the market for this last 12 months. We've engineered our business around transactions as the priority because interest comes and goes, and that we feel that's a risk for shareholders. It's gravy time right now, but when it goes to zero, you don't want your cost base geared around interest. So we've specifically focused on seeing interest as a bonus. Really, it's a top up on top of transaction fees. We also use that as leverage in signing up some of the larger contracts with Superfunds, ensuring that the interest is shared with them. In reality, I mean, the government would like to see that system go away, and we'd like to see real-time payments in terms of clarity. But the truth is the Australian banking system still relies on traditional deposits, which have a mandatory three-day clearance. So our interest is driven on that 3-day clearance period at the moment. But we're embracing modern technology, so our view would be, around 27, 28, I think we're going to see that start to disappear across the board in the market. On a positive offset, though, around about 2026, new regulations come in which are effectively tripling the amount of transactions that you require for super. We move away from quarterly payment of super to having it what's called payday super, having it in sync with your pay. Doesn't sound like much, but over a large, if you take, for example, if you were processing today, you're about $1 for dollar of interest and transaction fees in super. Post 2026, you're about $3 is to $1. in your transactions are $3, interest remains at $1. And then about 2027, that $1 starts to disappear as people move to real-time payments. So we've taken a very clear strategy that is go for transactions and ride the growth of transaction volume, which is sustainable into the next decade, as opposed to the ebb and flow of interest. Yeah.
And just quickly, Trent, I'm going to squeeze in one last one. You mentioned ART there, or Australian Retirement Trust as it's called now, or Sun Super as it used to be. I mean, we've seen a lot of mergers in the kind of super space, even at the very big end of town. I mean, Sun Super was big even before it merged with Q Super to make an even bigger one. Are those super mergers by and large good for you guys, or you know, or is it, you know, better to have, you know, a lot of these kind of medium-sized ones? You know, if one merges with another one, if they're not a client, it's like you're losing on one side sometimes, but you could be gaining, you know, a nice whole new client base on the other side. So net, I'm just trying to figure out, is that dynamic in the broader industry good, bad, or neutral for you guys?
Look, it's probably netting off, it's neutral. I think it depends on where your relationships lie, and if you're in the fund that's coming out on top in the merge versus the one at the bottom. So at one level, the mergers and acquisitions going on, the mergers are positive because it drives a change. If you are not inside one super fund, they have to transfer one of the entities onto a common set of platforms. So that at least gives rise to making a decision that they would normally say, it ain't broke, don't fix it. So we see that as right. We see it as a real positive. The second, though, is we tend to have been fortunate in our choices. So Sun Super merging with Q Super to become ART. Our technology footprint in there is quite advanced, and in fact, they're using it to drive onboarding of that stapling moment I mentioned earlier ahead of everybody else in the market. So I think we'll ride a tide of good fortune where by ART innovating on top of our platform, that showcases us and sets a new standard to the other super funds. But separate to that, we've played and built very strong relationships. Karen mentioned Link Group before. Link is the largest administrator and support all of the industry funds. So Aussie Super, Rest, Host, Cbus, for example. So by working with them, we've been able to put our brand in front of the largest players who are probably gobbling up some smaller players now. We've really moved away from what we'd see as the super merger phase, where we've kind of seen the market shake out now. There's definitely a top 12 that are the bulk of the funds in Australia. Yeah.
Okay. Aaron, Trent, we're going to leave it there, as I do know we have our next presenter lined up. Thanks very much for coming in, and yeah, we'll keep an eye on announcements going forward, and hopefully we can get you back in later in FY24.
Wonderful. Thanks for having us, Mark.
Thanks,
Thank
Trent.
you.
Thanks, Karen. And we are going to go out west now with Sam Budiselik from Cash Converters. Sam, if you want to start sharing your presentation, I'll let you know, and I can see it coming through here.
It's doing that now, Mark. Hopefully that shows.
Yeah, it's coming through now. And yeah, just FYI for anybody who doesn't know, results came out first thing this morning, so delighted Sam can join us on what's already been a busy day for him.
Yeah, thank you for having us, Mark, and thank you for having us on Coffee Microcaps. I'll just start by introducing myself. My name's Sam Budiselik. I'm the Managing Director of Cash Converters, and today we'll be talking to, as Mark mentioned, we released our FY23 results this morning, and the investor presentation that you can see on screen is online. I thought I would run through a brief overview of our business for those listening that either aren't familiar with the story or haven't followed the story recently. We'll talk through some key financial highlights and then finish with a strategy update and a view on our outlook. I think just a little bit about Cashies. We're considered a micro cap by market cap, but I think that's somewhat misrepresentative of the size, scale, and the volumes that we process in our business. We generally deal with a subprime borrowing customer. That's a customer in credit terms who has a credit score of under 500 and often has a mark or some sort of issue with the credit file or an irregular income pattern that makes it difficult for the banks to risk that customer. Therefore, the banks tend not to deal in our segment. We do think of ourselves as really meeting a cash need for our customers, whether that's buying something from us, selling something to us, borrowing from us. So we're meeting an underlying cash need. And our core IP and what we've built in our business that really has created somewhat of a moat for us in our subprime markets is our credit risk modelling. And that's predicated on many years of operation, a large data repository, and advanced machine learning credit models that we've built. And that enables us to risk an applicant that is not traditionally provided finance and to support that part of the economy as a result. We also operate the largest circular economy network of stores globally, purchasing our inventory from our customers to sell to our other customers, and in the process, eliminating the need for manufacturing and possibly landfill as we repurpose items and resell items. I think, just like I touched on in terms of microcap profiles, I think our market valuation is somewhat undemanding considering the size and scale of our business, and I'll touch upon why that may be. But I think it provides an opportunity when you look at our net tangible asset level at 29 cents, our price to earnings ratio sitting around 7 times our results, and the fact that we've just declared the 6th half yearly 1 cent fully franked dividend to make that 2 cents per annum for the last 3 years. That's been paid in dividends, fully franked is a reasonable yield in microcap space. Just to briefly outline our global network, we may be larger than people within Australia that know of us think of us. We operate predominantly a corporate and franchise network of stores where we are the master franchisor and the operator of corporate stores in Australia, New Zealand, and the United Kingdom. The rest of the world is a franchise network where we have master franchise partners operating Cash Converters stores where we support those operators with brand, trademark, IP, and receive a royalty for those services. So we think of our main operations really in Australia and the United Kingdom, and from those two hubs we operate globally. And Australia and the United Kingdom are the two growth markets for us as a result, where we're either opening new corporate greenfield stores or we're acquiring the franchise stores in those markets and folding them into our corporate network. Turning to slide 3, we do have a complex business model and we've tried to simplify that on a page. And hopefully this starts to paint a picture as to how our business operates. But we have the store operation, which I think is well known. And then through stores and online, we distribute all product. So a store operation under one roof will offer unsecured lending options to our customers, vehicle finance secured lending options to our customers, and our traditional retail buy-sell model. And our corporate stores that operate those models are paid a commission for any lending that's referred into our personal finance segment, plus retail revenue off retail turnover and pawnbroking interest margins. And we look at our product as an array of unsecured and secured lending products that are offered through the stores and online. And traditionally over time, our customers have entered our business on the left-hand side of the screen through small loans, or what in the national credit legislation is referred to as a small amount credit contract. And these are small loans up to $2,000 and 12 months in term that are legislated under the National Credit Act and have full responsible borrowing overlays applied sensibly as a function of the part of the market that we're offering that finance to or that has that finance need these products are well regulated. These small loans recently underwent another legislative change. They're commonly referred to as payday loans by the media and viewed in or positioned in somewhat of a negative manner. However, like I say, the fact they're well regulated, we believe there is a role for them in the market. However, a recent regulatory change where a 10% income cap was put in place for employed borrowers in this part of the market means that those loans are becoming more expensive for our customers as they extend in term, and they're becoming more difficult to offer. What we've done strategically is work hard in advance of that change in June this year that was really the result of a review that commenced in 2016 and kicked around for a long time as governments changed and as the political environment changed. We got in advance of that change and started releasing non-SAC products that we thought would be important to help us serve our customers if these changes came in as they did in 2016. And there were a number of other changes that we had already adopted in that SAC space. For example, equal repayments and other caps and protections that we already had in place. So as the customer comes into our lending business now, where they traditionally would have entered in through that SAC product, we're looking at offering customers the medium amount loans, which are loans up to $5,000, vehicle loans, pawnbroking loans, EWA or line of credit options. They're all regulated. All of the unsecured products are regulated under the National Credit Act, and the pawnbroking loans are regulated at a state police level. I think what's important to understand, though, is that as the customer journey proceeded in an orderly fashion with this disruption through these changes, not all customers will qualify for a medium loan, a vehicle loan, or a line of credit, or one of the other products due to the credit profile of that customer making an offer prohibitive. If passing responsible lending checks, that customer still has a likelihood to fail. We can't incur high loss rates on these other loan products that are structured and priced in a different way. Hence, it's important just to think about what's going to happen with the market. From a competitive perspective, we'll have lenders exit, I think, that don't have our scale. It will give us an opportunity to consolidate. Also, for people having access to regulated credit, this change is making that harder. And it's something we're turning our minds to trying to help solve for our customers. Turning to our ecosystem, in our presentation deck, we're just calling out the size and shape of our business. You'll see a large number of applications coming into the business, almost 800,000 applications for finance received in FY23. Obviously, as we assess those applications for suitability and for credit, we decline a large proportion of those applications. We will decline 7 out of every 10 loan applications that were received based on either suitability or creditworthiness. And we are transacting now about 15% of our turnover for our retail network online. Our retail platform, like I mentioned, is nicely integrated into our store network. Our store network acts as a value chain sort of sourcing mechanism for us for our inventory. And anything that's sold online is dispatched from a store. So you can go into a store and view an item, or you can buy that item online and receive that item delivered. But the online part of the business has certainly grown through that COVID period, and a heavier weighting to the digital transacting nature of our business still remains, like it does for many other retailers. I'll just keep moving through, Mark, in the interest of time. Briefly, our competitive advantage. We do have 100,000 active borrowing customers. Like I said, we're at north of 750,000 loans processed or applications processed each year. It's a large volume business with technology enabling us to quickly assess a small loan application and decision that. We do have a strong balance sheet with 71.6 million of cash at June 30. And like I say, we purchase about 2 million items a year that we're recycling essentially through our store network as we repurpose those items. Just in terms of the financials, we've got a number of highlights that we've called out in the deck. I'll move through this slide calling out some of the key highlights because I wanted to talk a little bit about the gross loan book movements and our individual loan book movements before summarising what that means for our underlying earnings. But predominantly, we're a finance business now. About 2/3 of our EBITDA at a segment level is coming in through the finance business, about 25% from our store operation, and then the rest from our vehicle and our offshore businesses. So personal finance is a really important part of our earnings composition. Throughout the COVID period, you'll see a big adjustment where customers were receiving stimulus from the government and in many cases prudently paying down loan obligations and settling outstanding loan liabilities. That resulted in our loan books decreasing slightly and our earnings being impacted. Also, the credit quality of the book's changing quite substantially from what you would expect in a subprime market in terms of loss rates, to those loss rates falling quite dramatically as people had more cash than they would have otherwise had normally. Having exited that COVID period, we've now seen the loan book demand re-establish. The cost of living's increasing. Organic demand is hitting record levels, like I say, up towards the 800,000 applications a year is a new record for us. Significant growth in demand is then driving the underlying loan book growth, even considering about 70% of those applications are actually declined. It gives you a feel for the size of demand through the market. So our gross loan book grew 27% across the 12 months to close at 271 million. We've got the individual loan books broken out down there below, and I'll just turn through to a segment slide calling out a key highlight. As I said, as we move out of the SAC loan, small loan products, in the last quarter of the financial year, we've seen that loan book decrease 6%. And that's a stated strategy move that we've repositioned towards other loan products as we've dealt with the customers that are impacted by these regulatory changes. As a result, pleasingly, across the 12 months, we saw the medium loan book increase significantly, up 34% now to exceed $100 million. That loan product was released, I think, in late 2016. So that book growth rate's really picking up and that book performs well. And it's a different profile of customer to that small loan book. As I mentioned, higher credit quality, lower loss rates and employed, and the loan value is up to $5,000 over 24 months. Our vehicle loan book also performed very strongly in 23 off the back of the severely disrupted COVID period for second-hand car markets where prices increased dramatically. We pulled out of the market somewhat and rebuilt our platform and our loan products. We operate our vehicle finance predominantly through a B2B network of brokers and dealers, and the business is branded Greenlight Auto. We do also offer the same loan product, essentially white labeled through our Cash Converters platform, direct to consumer. But about 80% of the business is B2B, offered through brokers and dealers, and about 20% direct to consumer. And that business, secured against the vehicle, has a higher average loan size as a result, around $20,000, can term over 5 years, but sits on average about 3.5 years. And finally, the store network has been significantly impacted with closures and other COVID-related impacts. And it's just good to see overall revenue growing 15% in that store network. As we've changed our inventory mix, we've gone for a deliberate shift to higher value items, luxury goods, watches, high-end electronics and jewelry, in a smaller store footprint for the newer stores that we're opening. That's enabling us to open in some more inner city high street locations and producing better retail turnover and gross margins as a result. So everything from sneakers, trainers, handbags, watches is being transacted through those stores now. It's quite different to what a suburban store may have procured in the past. And in summary, that's then driven some fairly strong operating results. Like I say, our revenue's now exceeding 300 million a year, up 23%. Our operating EBITDA lifted 8% up to 57 mil. There was some interest expense that impacted the net profit line, as lenders are experiencing across the market. At an EBITDA level, in addition, we've added a fair amount of FTE to our store network and internally to position the business from a risk and compliance perspective and a customer service perspective to be able to scale now. So we'll expect to maintain those revenue run rates, but hold our cost base fairly flat, and we should then see some operating leverage dropping out of that revenue growth into the business. That revenue number and the EBITDA numbers also include New Zealand, and I'll touch on that in a minute. So just to close, Mark, I think I'll just talk about our strategy a little bit. Often, as I said, with that SAC product being referred to as a payday loan, we've taken a deliberate strategic move to exit the payday loan sector, offering other non-SAC product as a result. We continue to innovate new products and release those new products, and we had 2 of those releases in FY23, and that's seeding new and growing loan books that aren't impacted by this recent change to the SAC product. We do continue acquiring our franchise stores. We have a great opportunity to acquire stores within our network at reasonable multiples. We'll transact around 3 to 4 times EBITDA or earnings multiples on those franchise stores. And we are, over time, looking to acquire both onshore and offshore franchise stores and network opportunities. And finally, in the UK, as we establish that hub in the UK and continue to build out in the UK, we see some good opportunity to grow offshore in a sensible way, where we have a really good management team that's come in through that recent acquisition. And we do see some new territory growth opportunities in Wales and parts of Ireland as a result. Mark, I'll take a pause there and just ask if there are any questions.
Sorry, we've had questions flying in, Sam. So let's
Oh, great.
try
There's a fair bit of information
and
there, and we do have that all available online, and I'm happy to take anything offline, but I just wanted to give a bit of an overview and update as to where we sat.
Yeah. Let's take this one first. Just on the dividend. Question on, can you maintain the 2 cent a year dividend while funding the transition of the loan book from the SAC product to the newer loan types? Let's take that one first.
Yeah, that's a great question. I think in summary, with anything that we're doing around investing for growth, we're trying to maintain that balance of a sensible growth rate and investment path, and the payment of a return to shareholders in the form of that dividend. And the nature of our business generating strong free cash means that we're in a fortunate position to do so. So as we grow our loan books, we do have funding facilities available that we're drawing on, and we'll balance using some of our cash to fund that loan book growth versus the cost of the facilities that are available to us. We'll look at opportunities to invest and acquire, like I say, cash converters stores owned by our partners, and just sensibly and steadily over time we'll continue doing that, and remain committed to try and balance that with some form of return. And that fully franked 1 cent half dividend is, like I say, the 6th time we've paid that, and something that we're aware of trying to maintain for investors.
Yeah, I think I worked it out there while you were talking. It's a 8, nearly 9% yield before you even factor in the franking. So even at 2 cents is pretty decent at the current share price. Just maybe on the funding, we've got another question on that. You know, again, the transition of the loan types. Does this then mean you're going to have a lower gross interest yield, but you make it up on lower funding costs? You know, better loan loss ratios and efficiencies on collection. Yeah,
correct. I think as a function of really from, I think it was in 2016, we only had a SAC loan product, and we had a vehicle lease product. From there, we've now got 6 different loan options, and we've dropped the leasing and made it vehicle finance. It's a much better model for us. I guess in summary, the loan books sit co-mingled in a single facility, and we believe as these individual loan books are reaching scale, it will provide an opportunity for us to consider options with funding, ideally just to provide some headroom for growth, hopefully to realise some cost benefit, and also with new loan product releases, as we're funding the growth of those new loan products, accelerating, shifting them into a securitisation facility and having them properly funded by a funder so that we can accelerate the growth that we're seeing. And all of that's a bit of a balance and a blend, but I think we're really in a good position now for the first time in my time to start to look at opportunities to optimize the funding side of our business and grow those loan books.
And then just a question on the strategy of, you know, converting franchises into corporate stores. If we take Australia, New Zealand is maybe one, and the UK is another. I mean, in the long term, should they all be corporate, or will we always see a situation where there's corporate stores and franchise stores, if we just talk about maybe those 2/3 markets?
Yeah, it's an interesting one, Mark, because our franchise network is very well established, as you can imagine, sort of commencing 30, 40 years ago. We've got a lot of partners that have been in the network for a long time, and looking to exit as they sort of near retirement. I think within Australia, where we do offer unsecured funding, that we don't in the UK. In the UK, we just operate a pawn and retail business. In Australia, where we're offering unsecured funding, it obviously comes with some pretty serious obligations to regulators, and also just in terms of corporate conduct and operation. I think what we've done a really good job of is making that a franchise model that works, and all of the franchisees operating as a corporate store would on our corporate platform means we can control that. And recently we've had to do a lot of work to uplift our compliance, our AML, and our approach to responsible lending, which is all public. So having invested heavily in the platform and built a model that works, in saying that, I favour acquiring our franchise store operation in Australia. Not only is it a sensible way to grow earnings and it's low risk, they're our stores, they're our people just owned by someone else. It's just eliminating that risk going forward that a financial service franchise operator would run. So I think in summary, we would look to acquire all of the franchise stores if we could reach a reasonable valuation with the seller. It's not always possible with a franchisee, but we've had a pretty good start to that program as we've built cash, buying and settling these stores. And I think the other point, just to make briefly, is that because we've got really good visibility of revenue in those franchise stores, we can put a corporate expense overlay on that store profile and adjust for how we would operate that store to come to a fairly accurate view on future earnings profile. And like I say, we're transacting at 3 to 4 times EBITDA. The models aren't too stretched. It's just working well for everyone, and where we can strike a good deal, we'll fold those stores into our network.
Yeah. And then just on the revenue split moving forward, you said, finance is kind of 2/3 of the business currently. I mean, if we were to look, let's say, 3 years out or 5 years out, should that be trending up to like 70-75% of the revenue base, or the other sides of the business also seem to be kind of recovering well from COVID? So try and get a sense of where the kind of splits are going to be if we kind of look out 3 years hence or 5 years hence, whichever kind of the term you want to speak in term.
Yeah, interesting question. I think the store network really operates as a branch distribution network for us, like a bank branch distribution might. The stores are really important in the local community, and the quality of the borrower that the store introduces is by far superior to an online lending applicant. We have a direct relationship with that customer. That customer performs better as a result. And that close contact and high touch service that we can provide customers that aren't always necessarily that sophisticated when it comes to understanding financial needs is really important to us. In saying that, the stores are paid a commission for lending that's referred to the personal finance segment within our account. So I think as the loan books grow, as we reach new customers online in that finance space that may not necessarily have come to a store traditionally, and we grow our market share in new markets, we'll probably see our personal finance business, if not maintaining that 2/3 earnings share, maybe ticking up a little bit, and stores ticking down a little bit just as that shift happens. But I would anticipate the stores will still remain a material part in terms of contribution, around that 25% of EBITDA. And overall, as our offshore businesses are growing, they might come down a bit, but a much bigger business with much bigger loan book should see that happen in a positive way for us all, I think.
Okay. And then, you touched on regulatory issues, which are part and parcel of this business, or any financial services business for that matter, not specifically cash converters. Is there, in the spaces that you operate, is there anything that's, coming down the track that's kind of been talked about or muted, or, you know, government white papers or green papers on that, you know, we should kind of be keeping an eye on, and you know, factoring in into looking at cash converters with what's potentially on the road ahead.
Yeah, look, Mark, I've had 8 or so years here now with an institutional banking background prior, and so coming in and understanding our customers and subprime markets has really been fascinating to me. Improving our relationships with our regulators was a key thing that I really started to work on early. We had an enforceable undertaking from ASIC around responsible lending, and from AUSTRAC around our AML-CTF approach. And that's not unusual, to your point, with other lenders that have been swept up in an uplift in terms of compliance. And that was necessary. And we really invested heavily and early and quickly to ensure we had that license to operate. Without that, we saw no sustainability going forward. So having addressed that, I think when you look at the product spectrum, small amount credit contracts, or SACs, those small payday loans as they're referred to. Like I say, a review has been kicking around for many, many years on that product set. And there have been unscrupulous lenders operating in the market that ASIC have now started shutting down, and we fully support that. So I think in terms of the product spectrum risk, we've really addressed that with these new product releases. I think with our footing and our whole corporate model and approach to our regulatory relationships, they've improved dramatically. I think we sit in a really good position now to say, as the biggest operator in our markets, which are tough markets to operate in, and a lot of lenders don't have the appetite to invest and you know, build like we have that opportunity to really now dominate. And I think as exits are happening with these difficulties that lenders are experiencing, it really just creates opportunity for us. And our market's growing as a result of cost of living pressures increasing, and middle Australia now considering us as an option, I think, as we've repositioned the business, is really positive to see too.
Yeah, thanks, Sam. We'll leave it there. Yeah, AUSTRAC, also good friends over at Westpac, if we want to go bigger up the ASX scale. also had plenty of run-ins there. But we're going to leave it there. Thank you very much. I'm sure you've got a few more of these still to get through this afternoon, and I do know our next presenter is waiting in the wings there patiently. So Sam, thank you very much.
Thanks for having us, Mark, and thank you to everyone for listening. I really appreciate your time, and it's nice to see you. Thank you.
And if we could just, Sam, if you could just stop sharing your screen, thank you. And the old saying goes, can't keep a good man down. We have the walking wounded here in Craig Dower. Welcome him back, CEO of QANTM IP. Craig, good to see you. Thanks for joining us.
Thanks, Mark. Good to be here.
If you can just pull, and I should say, sorry, also joined by Brenton, Lockhart, CFO of QANTM IP as well.
Excellent. And
thanks
for
sharing
inviting
it,
us,
or Brenton sharing it. I'll let you.
I'll share my screen. Yep. Let me just grab that and make sure that it comes up.
True now.
You can see that now.
Yep, I can see that now. You
Excellent.
can take it away, Craig, whenever you're ready.
All right, fantastic. Well, I guess start just by saying thank you for inviting us to attend your forum again, Mark. Much appreciated. And thank you for those that are on the call. My name's Craig Dower. I'm the CEO and Managing Director of QANTM IP, and joined, as Mark said, by our CFO today, Brenton Lockhart. And we announced our results to market last Thursday, and so we've been out doing investor presentations for the last week or so. I had my arm in a sling. I like to say that I did it heli skiing or something exotic like that, but I fell over on a bush trail last week and dislocated my shoulder, and I've got a number of fractures in it, so I'm off to surgery next week, which will be fun. So yeah, my arm hasn't been broken by a disgruntled investor. I did it entirely to myself. So it's been a busy week out talking to investors. We're really pleased with our full year results. I'll just quickly go through those in a minute, but just to set some context for anyone that doesn't know who we are, we're a group of IP industry, intellectual property professionals. We have three businesses, three brands at the core of our business. Davies Collison Cave, or DCC, very long-standing and well-known and respected IP brand in the Australian market, one of the preeminent firms in Australia with a global reputation. Freehills Patent Attorneys, FPA, came out of the Freehills law firm about a decade or so ago. Freehills is now a global firm known as Herbert Smith Freehills. And an FPA joined with DCC in our float, which was almost exactly 7 years ago, September 2016. And we acquired a business out of New Zealand a couple of years ago, an IP tech business called Sortify, that does a number of things, and I'll talk about them a little bit further on. We're just under 400 people, spread across 5 countries today: Australia, New Zealand, Singapore, Malaysia, Hong Kong. We're looking to expand our presence further into Southeast Asia and Asia over the next couple of years through M&A, and Brenton and I will take a bit of time to talk about that as well. Just quickly, highlights for the year. Our industry ebbs and flows on global sentiment around R&D, and R&D budgets tend to be reasonably protected during downturns and further invested in during upturns. The long arc of R&D tends to be a positive one, and it tends to be sort of GDP growth plus a bit. And so we grew our overall service charges revenue at 7.5%, which is a pretty strong result for us. Underlying EBITDA pleasingly was up more than revenue. I'll talk a bit about that. That hasn't been our story for the last several years, as we've been making a number of strategic investments, which we think are now starting to pay off, and we can see the results starting to flow through to the bottom line from that. Our underlying NPAT was up 14.5%, and we had a pretty positive result around EPS growth as well. We'll talk a bit about market share in a moment, but the market share for trademarks and patents globally declined a little bit in the last financial year, and we grew a little bit. So we're steadily growing our market share, and we've been doing that period by period for the last several years or so now. And we had quite a good half in terms of cash as well, and Brenton will talk about that in a moment. Just a quick snapshot of our business across the whole portfolio. So as I said, we're a full services IP firm. We cover patents, trademarks, and legal and litigation services, and we have an advisory business in and amongst all of that as well. Patents are just under 70% of everything we do, so the real engine room for finance and growth. Trademarks just over 20%. That's grown a bit in the last couple of years with the Sortify acquisition, which I'll touch on. And as you would have seen on the previous slide, there's a firm called DCC Law, part of DCC, which is involved in a number of legal and litigation services to our clients as well. And our service charges have been growing steadily over the last several years. And after several years of declining margins on the basis of investments that we were making, the last 2 or 3 periods now, we've been showing some modest margin growth as well, and we expect that to continue. We're a people-based business. At the end of the day, our single biggest asset obviously is our employees. About 80% of our costs are people-related, and so we do a lot to both attract new talent and also retain the talent that we have. Continuing to invest and grow in their technical skills, their negotiation skills, their commercial skills, their leadership capabilities, and so on, is a really important part of what we do. We invest a lot in diversity and wellness and so on. We sort of really amped that up like a lot of firms did during COVID, but it's become a fundamental part of who we are and part of our culture. We've implemented a bunch of initiatives around making this the best place to work in the industry. We put a 9-day fortnight trial in place within FPA about a year ago, and that's now become a standard way of operating. We're doing things like that all the time, looking at how can we improve the operating environment for our people. I'm going to pause there. I'll throw to Brenton to spend a few minutes talking about the P&L, and then I'll just touch on a couple of strategic initiatives and then sort of throw it open for questions. So over to you, Brenton.
Yeah, thanks, Craig. One thing that we've been really pleased on is it's been 3 halves in a row that we've improved our margins. So even though it only looks light on this page, 27.4% up from 27.2% underlying. What we did have was first half 23 was actually at 26.5%, and second half 23 was at 28.4%. And largely what that was driven by is we've normalised out of employee compensation 1.5 million there, which was a restructure that we did. And we've netted $1 million of annualised benefits in the second half, which has driven that margin growth. Now, if you compare to the second half FY22, it was pretty much the same margin, but that year had $900,000 FX gain. So we think these are sustainable and we expect margin growth to continue. The other couple of things that are in this result is $500,000 of impairment from our Sortify business. So what happened was globally trademarks came down, which we needed to reset our forecasts, and on a discounted cash flow basis with a high discount rate, we were impaired by $500,000. But the reality is we paid $11 million for that business 2 years ago. If we were to buy it today, we like the strategic capability and what it's doing. We would pay more for that today. The other thing in there was there's $900,000 uplift in our ECL. So during COVID, our average bad debt write-off went from about 600,000 and went down. So the way we'd been accounting for our expected credit loss was on historical loss rates. We had, again, with the shifts in the economy, we updated our management judgment. So we see a one-off $900,000 ECL expense go through. We had an uplift of $900,000 in sales and marketing spend, and that was mainly due to lockdowns that were in the first half of FY22. And again, technology, we invested a lot more as we moved through our technology modernisation, simplification and optimisation programs, which Craig will touch on a little bit later. But one of the milestones we hit through the year was we moved a lot of our old data centres. We retired those and we moved on to the Azure cloud, and we did some further investments in cybersecurity. Cash flow statement. This was a pleasing result because at the half, our cash conversion rate was about 32%, and we only had $1.7 million in the bank, and that was due to a soft Q1, a very strong Q2, and most of North America. So we get about 50% of our revenue from the US, 40 to 50% looking after their balance sheets at the 31st of December. But again, to be at 32% at the half and then come over at 99%, we had a very strong conversion in the second half due to increased focus on collections and updating our processes. But again, that North America paying a lot of their bills in January. The other thing that I'll point out on this page is lease payments are down from 5 million to 4.1. We have a strategy that we're working through here to reduce our premises. So we want to reduce our footprint by at least 40%. In this year, we updated our FBA Melbourne office, which accounts for 1.8 million of the capital expenditure for that fit out. That was one off. We've just recently moved FBA and DCC Sydney offices. But again, most of that lease incentive will fund the capital requirements there. And then we've still got our Melbourne office here where we've got about 5 floors. We probably think we only need 2 to 3, but that lease isn't out until the 1st of July 2025, but we'll continue to review and look at that. And on the balance sheet, pleasingly, net debt only went up 400,000. The main driver for that is we've got a USD facility. So as the US dollar depreciates, the cost of that debt, the value of that debt goes up. So even though we made repayments through the year, the amount of that debt is increasing. However, a lot of our debtor book is in US dollars. So we've got a natural hedge with that facility. So exposure is still $2 million. But that's what's put that up. But pleasingly, it was net debt at the half was 30 mil plus. Again, and the main driver for that was that cash issue that we talked about in the first half that is normalised. What we do have there is an acquisition facility of $17.4 million US dollars, 26.2 AUD, and a lot of the deals we're looking at doing or people we're having conversations with will fit inside that envelope. Statutory to underlying NPAT. Probably main area to focus is the middle. Restructuring costs I've touched on before. The SaaS costs, that's a continuation of that simplification optimization program that we normalised at 3 mil. So that was 8 to 10 million spend, and we're expecting 4 to 6 million in recurring annualized benefits. So at the minute, we've spent about 6.5. Budgeting to spend another 3.4 in FY24, which will bring our total spend to 9.9. Of the benefits, $1 million has flown through pleasingly in FY23. We expect another 1 to 2 in FY24. So when we add that together, it'll be 2 to 3 all up, and then another 1 million post that in FY25, which will get 4 plus. But Craig will touch on that a bit more a bit later. Craig, you're on mute.
Such a rookie error, isn't it? And we've been doing this for years now, still can't get it right. I'm going to quickly skip through these slides and just sort of come to a couple because I'm mindful of time. This one, first one here just talks about the sort of resilience of the industry. We look at what's happened during COVID, the IP sector really didn't skip a beat at all. R&D budgets continued to be funded in some sectors, even more so in the obvious places like, biotech, pharmaceutical, etc. Industry grows at sort of GDP plus, and so it's important for us to, over time, be in countries like Southeast Asia, ASEAN more broadly, where you see, pre-COVID GDP growth of sort of 6, 7, 8, 9% compared to Australia at 2.5. This slide just talks about growth in market share. We've continued to grow our patents market share over the last several years. We're at about 16.5% now in Australia. And on the trademark side, the two firms that we own, DCC and Sortify, are the number 1 and number 2 filers, respectively, in trademarks in Australia. That big kick on the right-hand side that you see around trademark growth was the addition of Sortify into the portfolio just under 2 years ago. Won't go through all of these. I'll quickly jump into the point that Brenton was making before around technology. This is a sort of multi-stage program that we launched a few years ago. We're about 3/4 of the way through. It's a sort of generational update, if you like, around technology and everything associated with our business processes and simplification of the businesses and so on as well. These things are never linear. You always have a few bumps along the way, but we're making good progress. We'd hoped to make a bit more progress last year. We're a bit delayed in getting some software upgrades done, largely due to the vendor of our core platform making a couple of decisions that sort of slowed us down a bit there. As Brenton said, the big thing we did last year was move all of our production systems away from data centers that we either owned or rented and moved into Azure, onto the Azure platform. So that was a big step change, required a complete network redesign, new VPNs, everything associated with that. That's gone very well. We finished that in December 2022, and then we're now in the process of upgrading all of our production systems and so on as well. As Brenton said, we're looking to spend about $3 to $3.5 million in the year ahead. And then when we get through that, that will have taken us through the big sort of program spend around our overall technology transformation and get us to a point where we're delivering pretty substantial benefits each year. As Brenton said, $1 million this year, which is now behind us and in the rearview mirror, 1 to 2 million cumulative on top of that one in the year ahead, FY24, and then another $1 million in the year beyond that. So we committed several years ago to that this program was a sort of $8 to $10 million spend, with $4 million, 4 to 6 million, I think we said at the time when we first started, of annualized returns. And as Brenton said, we will get to just under the 10 by the end of this year. And by FY25, we should be delivering the $4 million plus a year. Sortify is a very interesting business, founded by former trademark lawyers who had a view that the trademark industry was ripe for automation, and particularly if you could build a machine learning AI engine at the core of it that got smarter and smarter every time people use the platform. So they've gone from market entrance about 5 or 6 years ago to being the 20th largest filer of trademarks in the world today, number 2 in New Zealand behind AJ Park, number 1 in Australia now, just pulled ahead of DCC in this last period. Got a very rapidly growing business in the UK, which is a large trademark market, and in the last year or so, under our ownership, have expanded that presence into Singapore, Malaysia, Hong Kong, and Benelux as well. It's a highly scalable business. It's a development team of sort of 8 to 10 people, plus a number of IP professionals. We don't need to put people on the ground when we open up a new instance. It's really establishing a business, a registered business, making sure that we've got relationships with the local IP office, and then firing up an AWS instance of the platform, slightly customized, of course, for each of those countries. So in all of the countries in which they operate, outside of New Zealand, they don't have a team on the ground. So it's a highly scalable business over time. It was losing a bit of money when we acquired it. It was unprofitable last year. We expect it to be profitable and contributing to earnings modestly in the year ahead. But as it grows and scales, it doesn't need to add significant resource. So it's a very interesting business and quite a disruptor in the trademark sector. Basically, their clients are small businesses that are registering a trademark for the first time. Only about 10% of businesses that are registered actually own a trademark as well. So that's a very large market globally, and one which they're growing into. At the core of what they do is an AI engine, and that's being deployed in a number of ways on the platform itself, in a suite of attorney tools that Certify have built, and then looking at ways that they can help organizations like ours do things better, smarter, faster around automation as well. So that's our business as a whole. It's been a pretty solid year. The promises we've been talking about delivering for some time are starting to flow through on the back of the investments that we've made into earnings growth, which we're really pleased to see. We think the sector as a whole continues to show really strong resilience and defensive characteristics. Even during headwinds, we've been able to sort of maintain and grow market share. And as I said, on the trademark side, in a market that was down quite substantially globally last year, we were able to show that we could grow. As Brenton said, we're continuing to look at M&A opportunities. Asia, very specifically, is a big part of our focus. And I think that's it. So, Mark, I might just pause there and throw it to you and folks on the call for any questions.
Yeah, we've got one here, more for Brenton. I think the 3 million of technology product costs backed out of the underlying results, Brenton. The question is, are those ongoing software license expenses, or is it totally related to the big IT project upgrade? Maybe just a quick clarification just on that.
Yeah, no, pretty much all of that is related to the big IT modernisation. There is a small amount of ongoing licenses, but they are immaterial. And most of the license costs that we've got going through, we have that going through the BA tech line, and we're not adding that back. Okay,
perfect. And I just want to mention as well for people on the call, I know RAS Group cover QANTM IP, and they published an update on the latest result this morning, which I've loaded into the chat function. If anybody wants to download the report, it's in the chat now at the bottom of your nav bar. I'll just quickly mention that. Just on the market share gains, Craig, is that coming from a few maybe international players leaving the market, or are you winning customers, or is it the DCC business plus what's coming through Certify? Like what's driving that market share gains?
It depends on, it's a bit different in patents than it is in trademarks. So in patents, which as I said is sort of 70% of our business, we're doing a few things. So we're a very high touch firm, focus a lot on, we're kind of obsessed with client service delivery, right? So you grow your business based on how well you service your clients day after day after day. And so we're getting better at how we target business development opportunities within existing clients. So going deeper and broader across different practice groups and so on, helping support them in more countries. So companies that we may have been supporting with incoming filings into Australia, helping support them in Singapore and Malaysia and Hong Kong, where we now have a team on the ground. New business as well. We have taken a bit of share from competition where we've had sort of industry intel that the clients weren't happy, were being underserviced, had been sort of changes in people or whatever. So we keep our ear to the ground around that. And we're also getting better at how we spend our business development dollars. It used to be a sort of broad scattergun approach. It's now much more targeted, thinking about which clients and why, and what intel do we have, and why do we think we can expand and grow there. So a number of those things in patents. We do that in trademarks as well. The other thing that's helping our big growth in trademarks, though, is the addition of the Sortify business into the mix overall. And as I said, they're playing in a sector which we haven't really we've participated in. I mean, we've always at DCC, worked with startups and incubators and so on, and we continue to do that. But the Sortify customer is a bit of a different customer. They're not necessarily looking for strategic advice. They want to file a trademark, and they want to do it as cheaply and cost effectively and quickly as they can. And so the platform really helps accelerate and smooth that process, and do it at a fixed price, which is well within reach of most small businesses. And, typically costs sort of $600 to $800 to use the platform, whereas if you're using an attorney firm, it might cost multiples of that.
Another question from the audience here. Do you have any parts of the patent processing revenue you feel could be at risk in the longer term from technology, such as translations or renewals of the patents? Because I guess that's one of the other parts of the business is, these patents have to be maintained on a kind of regular cycle.
Yeah, I think anything, like in any business, anything that is process related that can be automated ultimately will be automated, right? And so one of the reasons that we acquired Sortify is we see them as a disruptor, and we like having a disruptor inside the tent rather than trying to work out what's happening just by observing the market. I think parts of the patent process, I mean, the question is very good, things around renewals and so on. We can't charge anywhere near as much for renewals as what we used to. It's a process step along the way. It's an important thing that needs to take place. Managing the deadlines that are associated with it and continuing to use it as an opportunity to engage with clients is important. And so I think there are, like our business, like all professional services firms, where there are things that are sort of process oriented that can be automated, ultimately they will be over time. Things like translations, that's a good question. Yes and no. Patent attorneys speak in a very arcane language. If you read patents, they're and you're not a patent attorney, then it's a surefire guarantee for insomnia, to solve insomnia. But they're very technical in nature, and within certain industry categories, they're even more technical, and they live within their own jargon. And so for the foreseeable future, regardless of how good translation technology gets, there's always going to be a need for some degree of oversight by patent attorneys. That technology, as all technology does, will get better and better and better over time. It's a relatively small part of our revenue portfolio today, as is renewals. And so, that's a long-winded answer, but the simple answer is yes, but in a different cadence in different parts of the business over time.
And I just want to touch on FX for a second, just given the expansion of Sortify. Maybe one for Brenton, since you mentioned the paying off of the debt, but with the way the Aussie dollar has gone, it actually looked like there was no movement at all. In terms of FX, should we think of it as a kind of a weak Aussie dollar is kind of net good for good for the business if we kind of look forward with, you know, more kind of international certify revenues starting to come through, or are we kind of not there yet, Brenton?
I think the way to look at it is if you go into the 4E and have a look at the minute on the balance sheet, I touched on our exposure is only about $2 million. But from revenues, because we've got so much in US dollars, 1 cent depreciation is a $800,000 increase to our EBITDA. So as it depreciates, that will push our service charges up because a lot of our clients get invoiced in US dollars. So it's about 800,000 per cent.
Okay, yeah, it's good to know, given things are bouncing around a lot. I mean, the last year I think we've been over 70 down to the low 60s, so yeah, it definitely will make a difference. Let me just check, have we got any final questions? No, I think and we're just up on time. Brenton, Craig, thank you very much for coming back in and giving us an update on all things quantum IP, and yeah, hopefully we can get you in later in FY24.
Fantastic.
Okay. Thank you all.
Thank you, Mark. Thank you all. Cheers.
And good luck with the surgery, Craig.
Yeah, thank you.
And for our final presenter, we're going to head out west. I'm very happy to have Dan Madden coming back to join us again. And I just want to call out Joyce's results come out this morning. So special thanks to Dan for making time for us today on what is no doubt been a busy couple of hours already. Dan, if you want to start sharing your screen, I'll let you know when I can see the cover slide coming up. And if you want to take yourself off mute as well, please, Dan.
How's that?
Yeah, your audio is fine, and we're just waiting for your prezzo to come up. It still hasn't come up on our side.
Okay.
Yeah, I can see it now, Dan, if you want to. There you go. Perfect. You can take it away whenever you're ready.
Well, thanks very much for the introduction, Mark, and thanks for those of you that are online for your interest. As I said, the results only came out this morning, so I'll really step through this presentation, which is the results presentation. A quick introduction. Our businesses are focused on helping Australians add value to their homes. We have the KWB Group, which has the trading brands Kitchen Connection and Wallspan. That operates in the do-it-for-me kitchen and wardrobe residential renovation market. We also have Bedshed, which is an established and recognisable brand supplying quality bedding and bedroom furnishings across Australia. And we launched Crave as a pilot into the Perth market in September 2022, which is focused on home staging, targeting property sellers and real estate agents. As we have a range of businesses in the portfolio, I thought I'd make it clear on how the value flows to Joyce shareholders. KWB is held 51% by Joyce, so we receive 51% of the profit. But as we hold 51%, we show consolidated reported results in our annual report and in some of our numbers. Bedshed's owned 100%. We receive franchise fee income from 37 stores in the network and operational profit from 4 of the company stores. And Crave obviously is owned 100% as a pilot. So they roll into the Joyce Group, which also holds the group cash of $46 million, and we are debt-free as well. Turning to the operating results, this financial year saw revenue and profit grow from prior year, underpinned by record revenue of 145 million, 12% increase on the previous year. We had tailwinds of strong demand in the first half, although we have seen labour market tightness throughout the year, particularly the second half, an inflationary environment and weakened consumer sentiment. But despite all of that, the overall performance has been very strong. We've ended the year with a very strong profit, record dividend, and a strengthened balance sheet as well. So when you combine that with the capital light and high margin nature of our businesses, I think we have a very solid footing to face any macroeconomic uncertainty and potential softening demand in coming months. Turning to the detail, the actual results in a bit more detail, and I'll step through the business unit results as well as we go through the presentation. I think it's important to note that the results are normalised. We've been doing that now for a few years. We normalise for after-tax impacts of any significant items, and what you see here are those normalising over the 2023 and 2022 financial years. The main material adjustments are with regards to the group's investment property in Lytton in Queensland, which we sold, and the corporate property which we sold. That really had an impact of giving a $6 million revaluation gain in 2022. So we've stripped out that upside gain to normalise the numbers, and we've also stripped out of FY23 the operating costs associated with the establishment and launch and ramp up of Crave, which is launched as a pilot. Despite the inflationary environment, we delivered improved margins for the year, which you can see there. We had modest increases in the overhead costs. That really reflected the business activities returning to pre-COVID levels. But overall, as a percentage of revenue, operating expenses remained steady at 25%, and I think last year they were 26%. Combined, that all came to a 25% increase in group EBIT, 22% increase in NPAT to Joyce shareholders, and we've ended up with a $9 million normalised NPAT to Joyce shareholders compared to 7.5 in the prior year after taking those normalising adjustments. We've announced a record for final dividend of 17.5 cents for the year. That's a full year dividend of 25.5 cents compared to 18 cents last year. The dividends continue to be fully franked. That dividend payment is within a payout ratio. It's actually at 79% of NPAT, which is at the upper end of our policy. We've had a policy now announced of between 60 to 80%. So we are right up at that higher end. Very strong year, good cash balance, and we feel that it's the right thing to do to let that flow through into shareholders, particularly given some of the uncertainty that we may be faced over the next 12 months. EPS is at 32 cents per share when normalised. That's when stripping out Crave. And at $3, we've got a market cap of about 85 million. The dividend yield would be 8% on the fully franked. And I think the PE ratio on the NPAT to Joyce shareholders is probably 9 times. And I'll let you draw your own conclusions from that. Looking at the cash, as I said, we ended up with a stronger balance sheet, $46 million of closing cash. We generated 31.5 from operating activities before lease payments and before tax. We had a $16 million received from the sale of the investment property, which has now been entered into a leaseback. And we also, during the year, reassigned our corporate property. During FY23, we held on to the corporate property that we sold, and we've been able to reassign that. So we now have no longer any obligations with that property. We just have our rental here at the Guthrie Street. Leaving the year with 46 million, as I said, of closing group cash, no debt. Importantly, I think they're just to identify that there's $30 million sat within KWB. So we have circa $15 million prior to the distribution of the dividend held in Joyce at 100%. And then obviously we have a 51% ownership of that cash balance in KWB as well. So strong balance sheet, no debt, and a good footing for the year ahead, which also means we're well placed to maintain healthy dividends into next year and beyond. Turning to the business units and how they performed during the year. The partnership with KWB once again continued to deliver shared success. It's a simple, robust and repeatable business model that KWB have. And we've been able to successfully expand the network over a period of time now of circa 10 years. Given the tight labour market, particularly in Sydney, we took the decision to defer new store openings in the FY23 financial year. We messaged that to the market, I think, over the last 12 months. We only opened one store, Casula, which was early in the year, I think August last year. But we did direct funds and resources to refurbish existing showrooms. We did a number of upgrades, and that was aimed to enhance customer conversion rates and overall productivity, which was a success for us. I'll talk a bit more about that in the numbers that come out in the next slides. We will continue with the refits and the upgrades into 2024. And we'll also look to seize any potential opportunities in the right locations in South Australia and Queensland. We have the Windsor showroom that formally closed during the year, but we announced its closure really from main operations in the prior financial year. And the Keswick showroom in South Australia will shortly close as well. That's to do with renewal of lease, not to do with performance of the store. We're committed to a long-term growth strategy, opportunity to double the footprint across Australia in importantly in A-grade locations, which are homemaker centres, and we'll certainly recommence opening new stores and our new store rollout in Sydney as soon as the constraints ease that we're facing at the moment, which is really labour constraints. The business maintained a track record of delivering consistent growth in earnings, installed more than 4,300 kitchens, 2,600 wardrobes, 14% increase in revenue to a record revenue of 123 million. You'll see in that top graph there, we had like-for-like revenue growth in existing stores. That was particularly Penrith and Belrose in Sydney Metro, which opened in FY22 and came online fully in FY23. As I mentioned, Windsor, which has been a long-established store, closed, and the loss of that revenue offset the revenue gained with Casula as that ramped up during the year. We have $111 million in orders we took during the year. That was after removing $13 million of old orders that were in the book, probably a bit of a hangover from COVID. So before removing those orders, we actually had orders taken of around about 124 million. We have seen traffic levels in the second half of the financial year decrease. Lead times are now reducing from what were abnormally high rates earlier in the 2022 calendar year and during some of the first half of this calendar year. The order book now stands at around $45 million, which does show continued strength of demand in the business. For those of you that aren't familiar with the business, during COVID, we had some real strong performance in the business, but we had some capacity issues in the business and some lead times that were longer than normal. So we're actually quite pleased that we're not operating with those sort of 4 or 5 month lead times that we faced in certain instances. Whilst kitchen renovations remain a primary focus for the business, the wardrobe orders also grew 13% on last year as we increased our design and installation capacity. I think that delivered around $9 million of orders, and I think important to note that that's only in Queensland and South Australia that we offer that service. We do plan to increase marketing initiatives in FY24. I think we'll need to do that to address softening trading conditions. And we've been very fortunate in the last few years that we really haven't had to spend much on advertising. So I think that may be something that changes and obviously may have a bit of an impact on the EBIT line. Looking at the EBIT and the results, profit results for the year, we effectively managed margins, continued prudent cost management, and the significant revenue growth gave us a record EBIT of 25 million, 31% increase from the 2022 financial year. We got growth in gross profit for the year during what was a high operational capacity. So the business was operating at capacity and was able to take advantage of that, which flowed through to gross profit margin. Minimal discounts needed, and cost increases from suppliers that we had during the year were mostly able to be recovered through pricing. We also continued to pursue productivity efficiencies. as a result of that, and that's an ongoing pursuit. Rework and warranty costs were down on the prior year, and they run at below 1.5% of net sales, and they're a pure loss to the bottom line. So that number of less than 1.5% is really, I think, quite remarkable and a real testament to the way that business is operationally run and the level of focus in the business, particularly across 26 showrooms. So as a result of all of that, we had a record EBIT margin, 20.5% versus 17.8% in FY22, and I think we're around 18 in FY21. As I said, we are seeing a current softening of the trading conditions. I don't think we're alone in that at all. That's probably likely to continue given the macroeconomic conditions that we have, and gross margins may normalise and lead times reduce to pre-COVID levels. But we'll take a very measured response to drive our growth and meet those challenges. As I mentioned, the marketing initiatives maintain the revenue, and we'll continue the tight cost control that we've had across this business. That 7-year graph at the bottom there, though, I think shows how there's just been consistent growth in EBIT and EBIT margin in that business. I won't spend too much time talking about the business model. I can maybe come back to that if I have time at the end, if anyone has questions. I think it's important to note that it's a capital-light business model with strong margins, excellent cash flow. It's very well regarded in the market, over 3,000 independent 5-star reviews now. We don't undertake production, strong working capital, with cash received up front from stage deposits before we have any outlay to suppliers on jobs. We're retail and residential only, so we're not exposed to new builds with developers. And I think importantly, we're a large player compared to the other competitors, but we're still a very small proportion of a large circa $4 billion market. And that positions us well to absorb any decline in the overall market size. Turning to Bedshed, we had continued network growth, introduced new franchise stores in Ballarat and regional Victoria and Castle Hill, took the franchise network to 37. Since the beginning of this financial year, we've secured 2 more. Jindalee has now opened in Brisbane, and Toowoomba in regional Queensland's planned around Christmas time. Very strong relationships with franchisees. We've had 1 franchise store up for resale in at least 10 years. A lot of the franchisees have been in for over 20 years. And our commitment here remains on network growth. I think we do have, we would only be fair to say there are somewhat tempered expectations given the current conditions in retail. But nonetheless, that is a focus for us. And we have a long-term planned network of 65 stores. Combined franchisees and company-owned stores and head office marketing and the products management teams all play a very critical role in the success of Bedshed, and they've delivered a very strong result in the current financial year. Franchise network business written sales are up 7% on prior year. Like for like, combined operations business written sales are up 3%, and combined operations, that's the company-owned stores revenues, up 1%. But that was slightly impacted by the fact that we undertook a fit out towards the end of this financial year, and that pushed some of our ability for securing sales. But those sales should flow into FY24, and that fit out's now complete. You'll see in the graph down there long-term franchise and company store revenue growth. I think what's important when you look at the combined operations revenue there is to note that there were 5 stores in the network to December 2020. So we've actually lost 20% of the stores from the company-owned revenue in that graph there in 21, 22 and 23. So I think that puts the sort of growth in perspective. I think it's also worth noting that there are no franchise agreements up for renewal during the current financial year, the one just gone, which is quite different from the 6 that we had in FY22, obviously contributing to revenue as well. So we've navigated the rising cost environment and managed segment expenditure quite well, I think, during the year. It's at 40% of revenue, which was an improvement from prior year of 41%. EBIT's increased by 3.5% to 5 million. The margin's risen for combined operations to just over 23 from just under 23. The franchise network has returned to pre-COVID levels of activity. Expenses have risen there from about 4 to 4.6. That's primarily driven by travel expenses as we reconnected with people, franchisees and our suppliers as those restrictions eased from COVID. So effectively, we probably got a more normalised margin that we see in FY23 for franchising. It was 46%, significantly higher than pre-COVID levels, but obviously not as high as FY21 and FY22, which topped 50%. We've enhanced our e-commerce platform and integrated bricks and mortar stores and e-commerce capability during the year. We have the ability for online purchasing, in-store purchasing, or both. For example, you can accept a quote online after being in store. And that's important to be able to do that and to allocate that to the franchisees who all operate independently to a degree, obviously within the network. So I think that's quite unique for Bedshed compared to some of our competitors. Drift is another step in the e-commerce journey. It was developed to target Gen Z and millennial markets. A simple e-commerce journey. The mattress is available in store, and you don't have to have been through the web, the Drift Sleep to actually purchase it. But you can also purchase directly online. The marketing is obviously different. This is a customer that we wouldn't normally get within Bedshed. So any sales that come from this are incremental to what we would have been getting otherwise. And importantly, it introduces Bedshed brand to this customer segment and builds the brand presence over the longer term, and therefore enhances the lifetime value of them for the Bedshed customer. And I particularly like the fact that what we can do here is target a specific audience with our marketing and our branding, rather than being an online mattress that is for all and sundry. And that was only soft launched in June 2023. Turning to Crave, we've had very positive feedback since the soft launch in September 2022. We've seen an increase in market penetration, revenue, and have had exceptional customer feedback. We have seen since early 23 that the home market has contracted quite significantly. I think there's been a 25 to 30% decrease in new listing activity in WA, and that slowed the ramp up of the business compared to our initial expectations. But we're now generating recurring business. We have an established network of real estate agents, and our near-term focus is certainly on building that network and increasing the market penetration to reach current operating capacity. We have a very disciplined approach to further allocation of capital. Any further allocation of capital will be dependent on the success of the pilot program, and we're not going to be diverting cash flows from our existing operations into Crave. So, as I said, while we're seeing turning to sort of the outlook and the growth initiatives, just sort of a bit of a comment on the outlook. We are seeing reduced foot traffic and softening demand as the interest rate rises bite. There is continued pressure of rising costs and labour constraints. We've got to manage those risks, but we've been successfully operating under very volatile and challenging conditions for some time now. We'll continue to be very disciplined in what we do and flexible in our approach to how we manage the business. We continue to trade above pre-COVID levels. We have seen a softening from prior year. As I mentioned, July orders in KWB were marginally down on July the prior year. Business written sales across the Bedshed network were down around 10% compared to what was a very strong July in 2022. We'll see how that plays out in the current year. Both businesses have very solid foundations to weather any tougher market conditions, very strong cash flow, working capital requirements are very low operating costs and high operating margins. So we're well placed for growth when the time's right. We've got large addressable markets. We've got an opportunity for footprint expansion where our brands are underrepresented across Australia. As I said, we've deferred store openings and further expansion into Sydney at this point because of primarily the labour constraints, but it's very much in our forward plans. And we'll also look to expand the wardrobe offering. Bedsheds remains focused on national growth, continue to develop a strong pipeline of franchisees and enhance that e-commerce offering. And with regards to Crave, well, we continue to see an opportunity for Crave, but it's still early days and any allocation of further capital is dependent on success of the pilot. I think importantly for anyone that sort of gets into the numbers and looks at FY22, we've had ramp-up costs that have been in the operating expenditure. We've actually had costs that have really established the business for the first 3 months of the financial year that have been put into the operating expenditure as well. So the operating expenditure levels in FY23 are certainly not what we would expect to see in FY24. And hopefully that leaves a little bit of time for some questions.
Thanks, Dan. Yeah, we've had a good few questions coming through there. I'm not sure if we're going to get through them all. So I might just say if we don't get to your question, I apologize in advance, and I'm sure. Yeah, there we go. You can reach out to Dan if you do want to. I'll just pick out some of the more interesting ones. One is Dan, can you just expand on how the franchise renewal drives revenue and how long the agreements are typically for? Is there an upfront franchise fee as part of a renewal?
Yeah, look, there's an upfront franchise fee on a new franchisee. Sometimes we waive that. It's not material when you sort of put 5 or 6 of them. You're talking sort of $250,000 potentially to 300 or 400 grand. When we renew, though, there is also a renewal fee as well in the same sort of ballpark. So I think we probably got around $250,000 to $300,000 last year from those renewals. So not overly material, but nonetheless, when we don't have those renewals, we don't get that income. The tenure is typically 5 or 10 years with 5 or 10 years extensions, and we obviously have the right of refusal on that.
Okay, and then just looking at Crave again for a second, what does success look like for the pilot? Is it revenue it brings in, achieving break even, or is it the kind of level of relationships you can build with real estate that you think, okay, if we have this at scale, across the broader Perth market or across some of the bigger markets over east, it'll be a good business. Just maybe talk about what you're looking to achieve from the pilot.
Well, we've set up the Crave pilot to only operate at a capacity that's a portion of what we think the Perth market is, and on the way of doing that, what we want to do is make sure that we have the learning of actually operating that model in the best way, to have the best efficiencies and to get the best revenue from that model. So there's a lot that we need to learn from that, but we can't, if we have success and we could say go from, let's say, 10% of the market to 20% of the market, we're not actually built for that at this stage with the assets that we have. And it's not really about doing that in the Perth market because it doesn't generate a material substantially material return for us. It's more about saying, okay, we know that there is a place in the home staging market to offer what we offer, that we can penetrate the market. And if we're at that sort of penetration rates where you're looking at, let's say, just for argument's sake, between 10 and 15% of the market, and we know that we can do that, we replicate that model and can build that into a larger market such as Sydney or Melbourne. When you look purely at Crave as a home staging proposition. We started the home staging model at this stage, and we're still being very disciplined with what we do, that we only go into homes that are empty. We're not doing partial rent out. We're not doing partial. We're not doing product into homes where people are living. So we have the opportunity to do that around the model as well, but that doesn't fit with our initial proposition where we think will be a higher return. So it's really to prove the concept in Perth I'm certainly above break even. If we're not making break even, then I don't see how we can say that we can, make the model work in a different and a larger market. So it's still early days to be able to make any decisions, of what real material success will deliver, to make decisions towards that, I should say, based on where we're at with Perth. But that's what we are hoping to do: get it to a position where we can make a decision to say, do we actually have an opportunity to take this nationally and make material sums of money in return for shareholders.
And then a question around the bedshed business. 2 new stores already in FY24. How many more for this year, and will these be to new franchisees or to existing franchisees expanding to a new location?
We have the 2 that we have in are new franchisees. We are continuing to look for continued expansion with new franchisees. We do have some existing franchisees who are keen to take on further stores, but we do have a limit to how many stores franchisees can have. I think it's 2. I could be incorrect and say it's 3. But we obviously want to make sure that the franchisee network remains competitive against each other, and nobody gets too large in that network, particularly in the more local areas, or metro areas, I should say. With regards to whether we get any more in this current financial year, there's obviously a fairly long lead time. We know we have Toowoomba lined up for around Christmas, so that's a 6-month lead time. We don't have anything lined up for the second half of this year at this stage. Otherwise, I would announce that. Hopeful that we will, but I think the retail climate, I think, is going to be important, to help us secure additional franchisees in this current financial year.
Okay, and then maybe the other side then, new kitchen showrooms in FY24. I know you touched on Sydney, probably not a starter at this stage, but in Queensland or somewhere else, when you look at the map, there's nothing in Victoria for that side of the business.
Yeah, absolutely. Well, I think until we have secured the Sydney market and expanded ourselves there, it probably would be a bit sort of presumptuous to jump into the Melbourne market. So I wouldn't say that was on the cards in the next the next sort of year or 2. That is obviously an opportunity. We need to make sure that if we enter into that market, we can enter into it at the right scale with suppliers and with the tradespeople that we need as well for the business offering, and make sure that we have the right network and the right scale of business to offer that to them at fairly early stages in entering into a new market such as Melbourne. Queensland, there is certainly opportunity. We are fairly well established in Queensland, but for example, we don't have a store in Fortitude Valley, for example. Windsor is closed due to flooding. We would look for a replacement for Windsor, but again, our A grade locations over the last sort of 12 years, that has somewhat changed, and somewhere like a Fortitude Valley, for example, is a prime A grade location for us in a homemaker centre, as opposed to somewhere like Windsor, which is more of 10, 12 years ago, where those homemaker centres were around a sort of a car park or what have you, and the other shops around there have changed over those years, and that's one of the reasons why we didn't re-establish in Windsor. So very much, if we can find the right location, we can go in Queensland, and the same in South Australia. Although we do feel that we can pick up a large proportion of the business that we'll lose from the Keswick closure in the next couple of months into the remainder of the network. So we're not overly concerned about doing that in South Australia.
Okay, Dan, I think we'll leave it there. We're slightly over time, and I do know the closing match is happening, and people are probably keen to watch that, especially with some results coming out thick and fast today. So thank you very much for coming back and giving us an update, and good luck with the road show rest of today, tomorrow, and early next week.
No problem. Well, thank you very much. Really appreciate the opportunity to be here. Appreciate everybody who's listened to giving me their time. Please answer any questions. I can see there are a few and I probably haven't got to them all. So I'll be more than happy to answer them either by email or by phone. If you drop me an email, then I'd be happy to have a conversation as well.
Yeah, thanks, Dan. Yeah, we didn't get to all the questions, so please do reach out to Dan if you want to line up a one-on-one or just send through the questions directly. Dan, thank you very much, and everyone joined the call today. Thank you. We're back again first thing tomorrow morning. We got another 4 microcap companies presenting 9 to 11, our kind of normal slot. Just check out LinkedIn, Twitter for who the presenting companies are, and hopefully I'll see some of you tomorrow. Thanks, Dan.